We are not a conference that gets together on the outside, all right? I want to make that very clear. We are a community. Maddox? I want everyone to we are a community. We're not like we're just going to do hallway stuff, all right? That's not what we are, right? We're here to listen and learn from each other. The first panel is, how should we be investing around the world? And I don't have my cheat sheet exactly to know, but I think refreshingly we have women telling us how to do this. There you are. Winston was supposed to be here. What's Stephen Burke? Where's Stephen? Do you mind waxing on this one? You're like Simon Vine telling a joke. No, it's good. All right. So no slides. We're all present. There's no need to go to your devices. We're here to ask the question, what scares and excites us today? We were doing this in London with Meredith. So listen up, Mirana. Joanne. We were talking, a fun fact about Meredith, that she was advising in the role of a McKinsey consultant as to what they should do with their future 10 years ago, and was the only consultancy to basically tell them how it is, how it should be. And you have to let them date and drink. I sort of stole your thunder probably a little bit. But you got other stories. Okay, so Colette was at our London conference the year before, which was sort of a jazz orchestra as we moved from assets to industries. We started moving people off the panel and onto the panel, if you remember that. But you, let me get you as but you were wearing a different hat at the time. And I'm looking for the other, there we go. I'll let you go first in a second. You went from a single-family office to a series of single-family offices. Roberta's going to back cleanup.
Story of my life.
But she also changed hats, right? We're all going to change hats a lot of times, except for Stephen Burke. Because you were, wow, too many hats I can't even fathom. You were in charge of countries for the World Bank and IFC. You then moved on to funds, and then you're an LP. I remember having conversations, we don't write checks less than 75 million. I was trying to screen my deal flow for that. And this is Uncle Stephen, if you don't know Stephen Burke. For how many? 235 weeks in a row, Tuesdays. At 11 a.m. Eastern, Stephen kicks off a discussion. And he's not one-sided. He goes to the bulls and the bears, the pros, the cons, Trump, the Harris, the whole bit, right? And by the way, we are having November 7th, a major event with 10 tax firms to talk about the post-U.S. election tax positioning. I think it's going to be a fun discussion. But we're here to just kick off and talk about what scares and excites you. And why don't you, we haven't talked about this for a month, but why don't you kick it off?
Thanks, Mark. Hi, everyone. My name is Meredith Morrison. I'm a director at Control Risks, which is a global intelligence and risk consultancy. And despite my folksy American accent, I sit in London in that role. But it's really nice to be back in New York. When we did this in London a month ago, I sort of purely talked about what excited me, which oftentimes is top of mind for that is Saudi Arabia, where I spend a lot of time. I was there last week. I sort of go out every kind of 6 to 8 weeks these days, after having kind of been there every week 10 years ago. But today I thought I'd talk about something that both scares and excites me at the same time, and has been kind of the theme of a lot of my conversations this week, where I've been connecting with more kind of American clients and American funds, because it's slightly different in the American space. I think people are finding Americans are going abroad for their investments, I think more than they ever have been. And one of the things that they're finding is that it's hard to go anywhere or sort of do anything without bumping up against Gulf sovereign wealth funds in the process, whether sort of intentionally or otherwise. And so a lot of my conversations are sort of decoding those organizations for clients over here. And it excites me because I'm an American who has been in the Middle East for approaching 20 years at this point, and I'm excited for everyone to be sort of coming out there with me now and sharing in the excitement of that place. But it also scares me, I think, because I want particularly sort of Western financial groups to be prepared for sort of who they're encountering and how they do business when they go out there. Yeah, and I have a lot more to say about that, but I might pause there. Yeah.
Decoding. I like that. All right, Colette.
Hi, everyone. My name is Colette Young. I run a multifamily office called Willara. As Mark mentioned, I was at his conference last year. I was Chief Investment Officer of a single-family office, investing in everything across public and private markets. One of my former investors in an old fund that I had seeded our multifamily office platform last year. So he rolled his single-family office into our platform, and we have since brought on, I think we're at 7 additional clients now in less than 10 months. So it's quite fast, it's quite large. We manage multiple billions, and we do everything across wealth, asset, and lifestyle management for our clients. So it's really a full holistic service, but obviously asset management is at the core. Our clients are all first-generation wealth creators, and so they take a very different approach to investing than your traditional, I would say, high net worth, ultra high net worth individual. They have all made their money in private markets and have been very instrumental in their spaces. So they are inherently private market investors. And so we take the view that if we are going to do a lot of investments, we do a lot of private direct investments, particularly in technology, in crypto. We've done a lot of stuff in special situations, in distressed debt. So right now, in terms of investing globally, obviously, we've spent a lot of time in the Middle East as well. I met one of my partners there working and building out a fund for a sovereign out there in Abu Dhabi, which is where I previously lived. And yeah, I would say from that perspective, we look at everything in different kinds of markets. Right now, we have done a deal in the past couple of weeks, a co-investment opportunity into a venture debt opportunity in Switzerland, which was quite interesting. This one was really interesting economics, 3-month holding period for a bridge for a company that we knew. We came together as a group. The large majority of our clients and families participated in it, and we're returning capital in less than 3 months. And so it was a great opportunity for them. Separate to that, we've done...
Let me just, this is a typical 361 question.
Yeah.
Tell us about a failure. What have you done that hasn't worked, and what did you learn from it?
Sure. So far, we haven't actually had many failures because we're a year old. So I would say, knock on wood, ask me next year. But I think in early stage investing, especially when you're a family office, you don't typically do a lot of private direct investing. We do. So I think that is a high risk for us. You can assess an opportunity, especially in crypto, which is something that we come from. We're crypto native. So a lot of our entrepreneurs and people that we've brought on as families have made their wealth in crypto, and they've been very successful, but they also are always risk on. So taking them from a very risk on approach to basically bringing them back and saying, okay, well, maybe we want to go into some wealth preservation stuff, maybe we want to put it into traditional credit strategies or something else, is a really, really tough approach. So a lot of the stuff that we do it's high risk. So we'll see what happens to them. We are certainly kind of judged like a fund in that regard. So far, we have had some very good trades, and we're value people at the same time. So if it's the right price, we'll scoop it up and hold on to it. The good thing about what we do, though, is we are a family office, so it's kind of evergreen capital. We don't really have mandates. We don't have a strict protocol on what we can and cannot do. So it's
maybe
a little bit different.
related, then you sound like the perfect nimble but big, like everybody wants to be you.
A lot of people do want to be us. That's correct.
So, like, who do you consider your competition then?
I would say that we aspire to be similar to like an Iconic, but for first generation wealth creators, maybe coming from crypto.
Gotcha. All right. So
Thank you.
Stephen Burke does not come from a crypto family office. Different heritage, different.
So what are we doing, Mark?
We're just what scares and excites. But you also hit on. We haven't talked about China today. The global. We talked about GCC decoding. You're going to run into the GCC. Someone's funding venture today. You sort of talked about different ways to invest. But maybe just your view. But I also like the little global perspective too, if you could.
Well, it scares and excites me first. What scares me really is the looking around the world. Where are the leaders that are going to deal with the problems that we have to resolve the wants, needs, and obligations of governments against what the people are looking for today, and do it in a way that moves us forward instead of moves us back? Our election is just one example of, where the statesmen that we used to see growing up, and I think that's it's being seen around the world. So I think that would be, when you have problems like we have in climate and debt and conflicts and poverty, all the things that we're dealing with, you need real leadership to do that, and we have not seen much from anywhere in the world. So I would say that would be one of the big things that scares me, because it's here and it's now, and a judgment mistake by any one of them could blow this thing up very quickly. So on the other hand, the innovation that we're all chasing around the room every day is probably the most exciting thing, and it's the answer to a lot of the problems, but not all of them, because most of the problems we have need smart people to sit at the table and come up, disagree on enough that they're going to disagree on, and then move forward with what you can with limited resources. So I think that's the problem we're facing. I think in that world, productivity is the driver for everything, and who wins is who's most productive, making the best of the limited resources that they're going to have going forward. I think the China issue and the U.S. issue are actually changing in a way that's scaring me. And I think the way we were both leading, we would usually lead with our allies, and now our allies are not following us. They're actually going off on their own. I think that's the case for both the U.S. and a little bit for China as well. I think we're both losing what we thought we were getting in the way we've managed our foreign policies and managed the global economy. So I think those are some of the challenges we're facing. On the other hand, I think there's just so much opportunity to solve some big problems if we focus. I think the problem with most leadership is they're trying to make everybody a little happy instead of deal with big issues that require big solutions and a big effort behind it. I did see something that was really disturbing in the FT this week on China that kind of is a symbol of where I think their model might be going a little off course. And it was a front page article where they were talking about teachers and public service employees being asked to turn in their passports and that they could apply to go outside the country later on. In that kind of a setup, that's not necessarily the contract that the public was getting with the Communist Party going forward. They were looking for a little bit more freedom and ability to grow, and I think if they're going in that direction, it's not going to be the one that moves China towards the dream that President Xi has there. On the other hand, if you look at our two presidential candidates, I don't think we're doing anything that's moving us in a more positive direction either. If either one of them got through with their economic policies, I think we would have inflation at a level that would be quite alarming for people. So I think we have to worry about those issues and hope innovation can get us out of those problems.
So with that, Roberta, you're all teed up.
I got some build up here from Mark earlier. It is true that I have been a principal investor for about 25 years before I switched hats and became an intelligence and risk consultant. Colleagues of Meredith's, I now run business intelligence for the Americas for control risks, which stems from the Arctic Circle to Chile, but with mostly focused on the U.S. and also Canada. But prior to this role, which I took on this summer, I think a lot of you have seen me before because I've been in here talking about what scares and excites me in global emerging markets for a while. So guess what? Actually, global emerging markets don't really scare or excite me right now. I think the big story is right here in the United States. So if you look at what happened after the global financial crisis, you had this kind of period of kind of a frozen period zastoya, as some of us who studied Soviet history know, a period of stagnation, in transactions, right? Because everything kind of stopped. The banking system almost failed. Investors kind of froze, and there was about a year and a half there where nothing really happened after 2008. But those people who were brave and put together term sheets and put together transactions that they might not have closed right then, but they were kind of looking at the current valuations, those people ended up having the greatest returns in the history of vintages in private markets. So end of 2009, 2010, 2011, changed the course of history and made private equity and private markets GPs, the masters of the universe that they are today. So where are we right now? It seems like a less exciting moment in time, but still it was a big moment when Gensler's SEC kind of waved their wand, said they didn't like some things that were going on about 2 years ago. The market crashed. All that private equity and all those VC funds who had been kind of in this period of effervescence, everybody was sitting at home on Zoom calls, raising money and doing deals. Remember that? Remember all that? In fact, that's when this organization really got big. People have been sitting on their stuff for 2 years, for 3 years, and the bid-ask spread has been wide. So guess what? That has to change. All those fund managers out there, they got to sell. Because if they don't sell, they can't return money to their LPs. Their LPs aren't going to invest them again. 2025 is going to be an enormous year of transactions. So what excites me? That excites me. That's one of the reasons I became a consultant. Because now instead of sitting in the corner with my little pile of money, I can, with my crack team of, there's 160 business intelligence consultants at Control Risk, another 100 that do kind of sector and political analysis, 260 consultants around the world. We can help people understand what they are buying, what they are selling. So it's a very exciting time in private markets going forward. But the scary part is what happens if you don't know what you're buying, if you decide to sell the wrong things. How do you make these decisions? What's going to make sense 2 years from now? That's what we all need to figure out.
And you've been advising those masters of the universe, or you collectively at Control Risk.
That's correct.
Right. So the private equity venture funds, particularly global ones, are your clients.
That's right, along with the Fortune 500 and a lot of ultra-high net worths and high net worths.
Yeah. So it's a transitionary, but you're also, just so everyone knows, you're looking to provide some of those services. We're doing a beta. Where's Julie? We're doing a beta for family offices to avail yourselves of these services. So we'll talk about that separately.
Very exciting project.
But Colette, we talked about China for a little bit, right? You have what's your view on some of these global landscape questions?
Well, there's no doubt that we're going through decoupling right now with China. We are very, I would say, geopolitically centered family office. So we take a macro wrapper on everything that we do in terms of our outlook. If you see the trends in the industries that we've backed, or the companies that we've invested in, or the funds that we get expertise in through specific industries and verticals, we choose these people and companies and funds because they're seeing the same kind of trends that we're also seeing. And that comes from a macro wrapper. So yes, we are similar to you in that regard. There is a rotation of capital happening There is a really interesting time right now to have stickiness and available capital to be able to pounce on opportunities, whether they are secondary opportunities, whether they are buying GP stakes in specific funds, whether they're doing distressed real estate opportunities in an area that we think has, a lot of potential for alpha. We are, kind of being at the pulse of that. In terms of China, though, we've seen some stimulus happen, some equities rally recently. Our view is China's dead stock right now, and it's going to remain that way for a while. We're very America first in our approach. Our clients are American, and we invest globally, but we certainly, take a different view.
So just, go ahead.
Just a quick one. Obviously, the China opportunity went from kind of offensive, and I don't mean it in an offensive way, but everybody piling in, trying to figure out what to do, venture capital, private equity, et cetera, to, let's say, defensive, right? I mean, there's still, of course, an enormous amount of business happening between the two countries. I just wanted to make a small plug for ourselves. So we actually, one of the only consulting firms that still has a significant presence. So we have 80 people on the ground in mainland China. Some things that we do from outside for security reasons, but we are there. So if your business in China requires some thought, some intelligence, please give us a call. We're still here for you. We understand that the headlines don't necessarily accord with the reality, which is that a lot of business is still happening.
So we have, again, at every other week at 8 a.m., we do another briefing edition. So you get Stephen twice in one day, and the 8 a.m. picks up more Asia. But still, after 5 years, we had a ton of people from China that it's a vacuum. There's no one coming to our Zooms, even from Hong Kong anymore. But what we talked about at 8 a.m. was how farcical the capital markets are in China. Like, where do you exit? And are those valuations real? So it's just whether there's a bifurcation, but there's also the politicization of the capital markets. So just everyone, absolutely. It was India versus China, and I have the great thing, for good or for bad, these are recorded. So you'll remember, and he's been recorded for 200, the week after COVID hit. That's the bad. He had to be on point. Like, what's going on, Stephen? But I remember, don't go to India. No, hey, can't get your money out. Now India's the darling, right? And China is what it is. But it's still innovation heavy. They're a force. So we're and 60% of Walmart products are coming from China. So this is not it doesn't decouple immediately. Now you've heard. So what does the GCC think of this bifurcation? If I could put it back to you.
Great question.
Play it both ways as much as you can.
That is the GCC approach for the most part. Although I think the degree to which China and the UAE individually have been sort of attempting to play both sides has diverged recently, where I think maybe one interesting thing is where the UAE even sort of previously had one fund in particular that was sort of meant to be especially kosher for American regulators. Even that fund now, I think, speaks of itself as, I think, pursuing in line with the UAE national strategy of they're sort of calling themselves a nexus between East and West. But what that means...
UAE, which I think the UAE is important. But what about KSA?
Yeah, I think China, there's a lot less China and Saudi than there is in the UAE, and that's by design. I mean, I've also, speaking with Saudi clients even, have had conversations where they've said, we've only got, they're trying to, one of the many things they're trying to do with the vision is increase manufacturing in the country, right? So if you or anyone you work with wants to set up a manufacturing shop in Saudi, you will be welcomed with open arms. But
if you're just looking for capital.
But in one case, speaking to somebody who's at one of the funds in Saudi, he said, well, we've only got sort of Chinese bids to do this particular manufacturing project so far, and we'd really like to see some from Europe or America. So I think that really speaks to the difference between the two countries.
Which is the same. We haven't talked about Africa today yet either.
Yeah.
Africa 5 years ago, we were a void, and then China was filling that void, and that's also interesting that it's a similar observation, I guess.
Yeah, I think there were a lot of lessons learned from that period with Africa that I think are people are sort of looking not to repeat in other places. I think maybe one thing to pull out about the UAE then to sort of draw out this contrast is that after the big deal with G42 and Microsoft earlier this year, G42 is the Emirati technology company, and Microsoft is Microsoft. And there was a deal that was sort of driven by kind of behind-the-scenes national security machinations to get a large investment from Microsoft into the UAE to drive quote-unquote responsible AI development. And part of the deal was that G42 was supposed to decouple from China in exchange for that investment, and it was in some cases improperly reported on to say that the UAE stopped pursuing technology investments with China, but that's not true. They just got moved into a different body in the same ecosystem.
Which is, we've been talking about, there's so many workarounds that China's come up with, too. Let's open it up. Questions? It's the pregnant pause. Okay, yell it out, Jim. By the way, Jim, this is Jim's coffee machines back here. He actually has a steel company that's making $5 million of EBITDA, but he stumbled onto this and he's going to run with it. He thinks it's a multi-billion-dollar opportunity. But you have a question?
At least a multi-billion.
Yes.
So we've talked about China and how China was the maybe a paper tiger. But it kept us, the Americans, on their toes. And is there some sense of when we lose a competitor nationally, that we, as a country, kind of lose our focus? And I think, Stephen, I agree with you. There's a lot of problems right now internally, and it helps to be focused. Without a competitor, and I don't know if that will be India, and I don't know if that will be Africa, but it appears it's not going to be China. What are the risks now to the U.S. economy that we continue on our path, which I think needs to be fixed, and we were only going to fix it with external competition. And now that we don't see having an external competitor like China threatening us on all fronts, we can maybe get fat, dumb, and lazy.
I'm not sure I buy that. Yeah.
I don't buy that. I think that your paper tiger comment is a great comment in the sense that, first of all, we have yet to see another national actor that kind of does everything that we do. That does not mean that we are doing everything correctly, because I definitely don't think we are. But think about the late, I'm sorry to sound like I'm 100 years old, but think about the late 80s. It was all Japan, 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 right? So they're going to eat our lunch, they're buying the Empire State Building, et cetera. So, and then we kind of came out of that. We had a sort of period of mild recession, but we kept going. The U.S. doesn't have one competitor. It has multiple competitors. And if you look at where we need to be as a country and as the world, which is, we need to head towards a lot less carbon if we want to be alive. I mean, look at these hurricanes in Florida. The lack of industrial policy that we've had here in the U.S. Meant that the kind of market imperfections that exist in that renewables and carbon capture and net zero space, we were not able to compete. So it's good that we have a little bit more of that going on today. But who are we competing with there? We're competing with the Scandinavian countries. We're competing with a bunch of different people. So we're on our toes because we're fighting a million battles in a million different places.
I would also just point out, to go on top of that, post-Cold War, America went through a massive globalization, right? So we joined forces with China, and it was a fueling campaign which has kind of put us in the position we are in today. Sooner or later, that was going to slow down because America goes in cycles, right? Countries work in cycles. If you think about it right now, we're going through a cycle that is ending this industrial, institutional cycle, this socioeconomic cycle that America is currently in. So if you think about it, this is actually kind of part of the course. And are we going to decouple? Yes. Are we going to go through fragmentation? Yes. But will America still transpire and end up on top at the end? I would like to think so. Why? Well, historically, America is centered in a very different, unique place. We have a lot of natural resources. We have access to international trade. We have oceans on both sides. We are the global reserve currency of the world. You know, realistically, no matter how threatened the US dollar is right now, it's still the US dollar. So, something to think about.
Yeah.
I like America, yes.
What's interesting is we are the reserve currency, and China would have a very difficult time ever becoming one as an autocratic
No question.
nation. But Jim, I'm not sure I would count as China is out. I would say they're just down right now. And they're such a good competitor, and they're so good at so many different things, and their edge in so many areas is high that I think we have them as a competitor forever, unless we decide with China to do the right thing, which is to partner and lead the world the right way, which I don't see happening in the current construct, either with our leadership or theirs. That said, I think the issues that were just raised are creating massive opportunities for investments. I think the one with climate all over the world, be the climate wars, the reconstruction that's got to go on around the world, and the money that's got to be put to rebuilding Florida, the Carolinas here, Ukraine, parts of Russia, go around to the Middle East. What we have to do there, we have more problems than money. But yep. And that is one of the best opportunities, I think, is the aggregate space is one of the ones that we're heavily invested in right now. Steel is, Jim, is your business, but there are a lot of opportunities to make money with all the problems. But I think you have to look past the geopolitics, and I wouldn't count China out at all.
Yeah, I just want to add, I don't know if everyone has seen that. So there's a lot of factories actually moving out of China and going to like countries like Vietnam, Mexico, and some of my clients were told if they don't move out of China, they're not allowed to sell certain like auto parts in United States. So they start building factories there. And so I think if the two countries, not getting along well, it's not going to help, China economy. But in terms of U.S. economies, I'm focusing on public company markets. So a lot of companies around the world, they come to U.S. exchanges. It's still the strongest exchange around the world with the most liquidity, and that's what I see.
And I also in most cases, they can move over and get a multiple expansion right off the bat. So, I know one of the good big aggregates companies out of the UK, CRH, did that, moved over with like a 13 multiple, and I think is now up to a 19, mainly because their competitors, which be Martin Marietta, were 21 multiples. So it was the same business, just sliding into a different valuation market.
Yeah, we had a deal we didn't get when I was running a SPAC before, but this was a Taiwanese golf club manufacturer. Literally by moving over, they got a 2x, just multiple ways.
I will say, my background actually comes from fashion. So I started my first company in 2004. And so I lived in China, I lived in Shanghai, I did manufacturing in Shanghai, so I know it quite well. I will say, though, in terms of your comment, you're right. My first job in venture was at First Smart Capital. My former boss had started the fund, unicorn fund, 10x, like super successful. First investment we did was Pinterest in that fund, so it was very successful. Then Shopify, and it just kept going, unicorn after unicorn. From there, though, he ended up launching, taking $60 million of his own capital and putting it into a manufacturing AI facility to revolutionize the production for all different types of things through AI. And his factories are getting opened up everywhere. So the Dominican Republic, for instance, he's looking in the Middle East right now. But the point is that the problem with manufacturing in general is it's so reliant on various different factors. And then the problem with that is specifically around waste. So the industry always has a number of things that goes wrong in terms of excess materials, things that are bad for the environment, not being able to sell the goods. You're seeing fashion brands implode right and left. Why is that? It's because the model is all fragmented and wrong. And so you actually have to start at the very beginning and understand the entire supply chain from the very beginning as to a designer or a brand and how they even come to creating a vision for themselves and then going through the entire stack down to distribution. And if you don't do that, you're just going to continue to run into the same problems over and over and again, which is what we're facing in that industry, which is actually quite large. It's a $1 trillion industry, right? So it's not something to disregard in any capacity. But I will say that China's heavily reliant on oil, and they import that oil through the Middle East. So conflict happening in the Middle East, which is what we're seeing right now, which is a main actor for obviously Iran, is something not to not lose attention on, right? So this is actually incredibly important to know. So it funds that kind of manufacturing. Supply chain then is a trickle-down effect. So when you actually look at import, export, and supply and demand, the reason why we're also seeing a massive slowdown is because people are not going to want to import or export from China.
This could be a 5-hour panel, right? But we have to move on to asset classes. So, but here's how it's going to go. If you don't know 361 conferences, we have one more panel, and then we're going to go into breakouts. So there will be regional. There'll be a GCC. There'll be in Asia, which will be heavy India. Just it is today. I remember that 5 years ago, the Asia panel was like, or the breakout was huge. It was all Chinese Americans at the time. They're not here so much. Anyways, then we'll talk about the most sexy thing in the room, which is private credit, which is the sector we raise the most money in. We do raise capital for funds and companies. And we'll talk about venture, and we'll talk about everything else. But venture's been a tough one, so it's a bit interesting. And then the secondaries market where you guys play. So let's first thank this panel for kicking it off with such positive, some bright lines around the clouds about innovation and technology, but we're in a cloudy environment for sure. Thank you. Thank you. So if we're going to move on to, Rich Nispola, Greg Wilder, Suzanne, Brian Walter.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.